Hello and welcome to Money Matters TV. I'm your host today, Patricia Dunn from Merrill Lynch Wealth Management, and specifically the Dunn Wealth Management Group in the West Conshohocken branch of Merrill Lynch. And my co-host today is Mike Dever from Brandywine Asset Management. So you have two top-notch professionals in the financial field today. And our special guest today is equally impressive. We have Molly Watson, the CEO of Evolution Engine. And Molly has spent well over 30 years in the marketing and communications field. So she has some very interesting things to say today. Now, before we get started, I was having an interesting conversation with Mike before the show, and we were both comparing notes as to what we're hearing in the way of questions these days from prospective clients. And both of us agreed that the number one question that seems to be on people's minds is retirement planning. And interestingly enough, when they approach Mike or myself, often the first question is it really true that you need $1 million or $2 million in order to be able to afford to retire? And my answer is, for some, that answer is yes. And for some, it's even more. But retirement is a very important time to be extremely careful with your investments and your assets, because you are exiting the workforce, and what you have is what you have. So I always encourage people at this stage of your life, at no other stage, at least at this stage, make sure that you work with a seasoned professional with credentials after their names. A Merrill Lynch, a Brandywine Asset Management, or a number of other top firms. And you want a certified financial planner, because the software that we use to crunch the numbers does come out with a 95% certainty. Now, there's a lot of off-the-shelf and free retirement planning apps out there and firms that offer free financial planning. But a lot of those apps will say, congratulations, you can retire, and they only have a 75% certainty. Now, at this stage, there's a big difference in the comfort zone between a 95% certainty and a 75% certainty. But what I'd like to do is dispel a couple of myths and give you a couple of points of thumb that may be able to be of help to you even before you approach a professional. One thing that you should realize is that we tend to retire here in the United States on 60 to 80% of our pre-retirement income. So you and your spouse need to grab the old calculator, because in this case, the calculator, old or new, is definitely your friend, and sit down at the kitchen table and say, okay, what do you make gross per year? What do you make gross per year? Add the two numbers together. The reason I say gross is because you will pay taxes in retirement just as you paid taxes before you retired. So you come up with a number. Then, if you live a modest lifestyle, multiply that by 60%. If you want to do some traveling, redo the kitchen and the bathrooms, multiply that number by 80%. If you really have no clue, multiply it by 70%. Because what you're doing is not carved in cement. What you're trying to do is get a picture of where you stand. So you multiply the combination of incomes by something between 60 and 80%, and you have a number. Now, from that number, you start subtracting all your guaranteed income streams in retirement. What are they? Social Security. You have it, your spouse has it. Figure out what that's going to be on an annual basis and subtract it from that number. If you are lucky enough to have a pension, a military pension, a teacher's pension, there's not too many pensions around anymore, but if you're lucky enough to have one and have an annual figure that you're going to get from that pension, subtract it from that number. If you have an annuity, or two, or three, remember, an annuity is not an investment. An annuity is a future income stream. Call the annuity company and tell them, I'm thinking about annuitizing my policy. I'm not ready to do it yet. I want to know what my options are, and I want to know what kind of income stream I can expect. So you've subtracted all your guaranteed income streams from your number, and that leaves you with a number. Now, with that number, let's say, for argument's sake, it's $100,000. You take $100,000 in your calculator and you divide that by decimal point 0.04. What's decimal point 0.04? It's 4% expressed as a decimal. Rule of thumb: you don't want to take out more than 4% of your assets if you want your assets to last. Now, conservative people say you don't want to take out more than 3%, but let's stick with 4 for now. So you've got your 100,000, you divide it by decimal point 0.04. That's 2.5 million. Holy mackerel. That's what you would need, preferably in retirement assets, to generate safely a cash flow of $100,000 a year. Now, maybe your number isn't 100,000. Let's say your number is 50,000. So we put in 50,000 and we divide that by 0.04. Now you're looking at 1,250,000. But maybe you have a lot of sources of guaranteed income, or you're at that 60% and you live modestly. So let's say you came out with 25,000, which was what you were trying to make up. All right, $25,000 divided by 0.04. Now you're looking at 625,000. So maybe you don't need $1 million. Maybe you do. But until you do the math, you won't know. Now, I would urge you to be careful. There's a lot of ways you can go down the rabbit hole when it comes to retirement planning. If you see promises of cash flow streams on low equity balances, grab that calculator and do the math, because I have seen implications where one could get 8.8%, 9.6%. That's assuming you're taking a lot of money out, and it's assuming you're going to make an awful lot of money on the declining base. If you take out 10% per year, think about it. How long is your money going to last? It's going to last 10 years. And we can be in retirement for 30 years or more. Now, another myth that unfortunately is very pervasive, and I absolutely want to get it out there, that this is not true. And that myth is that if I'm 65 years old, 65% of my portfolio should be in bonds. And when I'm 75 years old, 75%. When I'm 100, 100%. Wrong, 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 wrong. And I know Mike feels as passionately as I do and has some comments to say about this. But let me say this. Interest rates are very simple animals. They only do three things. They go up, they go down, and they stay the same. And right now, they're down. They're way down, extremely low. And they have nowhere to go but up. And when interest rates go up, bond values go down. And to be 65 years old in retirement with 65% of your portfolio working against you is not a happy place to be. So, Mike, I'm going to ask you to add to that because I know you feel as strongly as I do.
Yeah, Pat. Hey, thanks. So a little while back, I was asked on a Bloomberg interview what the riskiest investment was out there. And my comment was bonds. And the reason is because you're locking in a return that's in the low single-digit percentages. And if you're trying to make some money, you're even talking about, say, a 4% withdrawal rate every year. If you're getting 2% or 3% on your bonds, you're guaranteed that you're cutting the principal every year. You're going to be losing money. And obviously, if inflation ticks up at all, the bonds aren't going to keep pace with inflation. So it's pretty easy to look at it. And as you mentioned, bonds are a pretty simple animal. You can look at them, you see a number. If you hold it to maturity, that's the interest rate you're going to get, assuming you do get paid off. So say a government bond. And you're locking in a rate that's probably lower than you need to achieve in your portfolio to meet your retirement goals.
Great. All right. Well, are you ready for a question, Mike?
Oh, sure.
And we have a viewer question from Eric Wendell. Eric Wendell is from Wayne, and he wants to know what's so good about index funds.
Okay, I'm going to give a good and a bad, but because that's just how I live. But the good is that there's really two main goods, and the one is that in one package you get a portfolio that's diversified across a variety of stocks. You don't have to make those individual stock decisions yourself. You end up with it's not a diversified portfolio by any means because they're going to all tend to fall in sync with each other. But at least you don't have to make a lot of individual stock decisions. The second is the fees. The index funds now are practically free. So you can get in there, you can hold that position, you can hold it for a long time, get long-term capital gains when you sell it out, and pay very little in the way of tax or fees on the investment. The downside is you got naked risk exposure to that basket of stocks. And I mean, it's going to happen that over time, there's going to be periods where you're going to lose 20%, 30%. In the financial crisis, over 50% of your money, over 80% if you're in the NASDAQ, but over 50% of money just in a broadly diversified index fund like the S&P 500. So that's one of the things Brandywine does is we create products that protect people from that downside. So like an index fund, but with protection.
All right. Well, I'm sure our viewers out there have a number of questions, particularly given the number of questions that Mike and I have received on retirement planning. So if you'd like your questions answered on Money Matters TV, here's how to submit them.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Welcome back. And now we turn our show over to our special guest, Molly Watson. As I mentioned before, Molly has well over 30 years of experience in the marketing and communications field. Most of this was spent in corporate America, working as running advertising agencies for corporations. And she has now branched off into her own firm, the Evolution Engine, where she works with C-suite individuals to tackle the big business problems when it comes to marketing and communications. She will optimize what's working well. She'll make suggestions to fill in the gaps for what's missing. And ultimately, she helps drive business. So welcome, Molly, to our show.
Thank you so much, Pat, for inviting me to be a guest today. It's really, really nice to be here.
Well, let me start off with questions. Maybe our audience would really like to know, an overview of your career journey and maybe a few specifics about what you're doing now.
Sure. Well, I have had a fantastic career in advertising and marketing that started in New York on Madison Avenue at a global agency just after college. I worked on a variety of brands that you may recognize like AT&T, Advil, Kraft Foods. In 95, my husband and I relocated to Philadelphia and I joined Tierney Communications, which was my professional home for over 20 years. The last decade there, I was honored to serve as the chief operating officer, helping lead the company to its highest levels of profit. So now I run my own business consultancy, Evolution Engine, and I work together with business decision makers to help them develop growth strategies and implement those growth plans for results.
So, what made you make the decision to jump into your own practice? You were with Tierney a long time. We actually used Tierney when I launched Spree.com in the 90s.
Yeah.
You guys worked with us and helped some of the promotion with that business. What caused the decision to go out on your own?
Well, I think I was there for just about 22 years, Mike. And about 3 years ago, I just started to think about what the third chapter of my career would look like. I spent the first chapter in New York at one place, the next very fulfilling chapter at Tierney. And I just started to think, what is it that I would do next? Tierney is part of a huge publicly traded holding company. So we were driving growth to meet targets for shareholders. And as I said, working together with the leadership team, we achieved really great things beyond revenue and margin growth. We built a culture that was nationally recognized in the industry, cultivated and nurtured the next level of the firm, as well as added new service areas. So I had a calm sense that my work there was done, and I needed to let the others who we had been cultivating sort of step into their full potential to lead. So that, and to be honest, coupled with the fatigue of the grind of the business, if you know anything about advertising, it could be pretty crazy. I just stepped aside and took some time to think about what I would do next. And while I explored other job opportunities like chief marketing officer jobs or potentially joining large scale consulting firms, like PwC or Accenture, I had a former client call me who was the CMO at Wharton. And she said, I have a problem. Are you doing anything? I said, well, no, I'm in between. She said, can you come help me? And so that first consulting gig lasted 10 months and it led me to pursue the consulting business I have today.
I see that as being pretty common. People get moved in, they get pulled in to the business. And that's a great way to start because you've got a immediate client. You're not hanging up a shingle trying to find where revenue is coming from. You start with the revenue and then you decide to put the shingle out. That's great.
Yeah, that happened to me in a couple of cases. So
yeah, excellent.
That made it lucky.
Tell me this, Molly. After spending almost 30 years in corporate America, how did that prepare you for then being on your own? Was anything particular that really was helpful as you made that step?
Well, I think that I'm confident that my experience in corporate America gave me fantastic training, working for very large corporations, publicly traded. So I was taught over time, a degree of professionalism and certainly presentation skills, but more importantly, how to run a financially healthy business. And again, at that time, it was all within advertising and communications. But the interesting thing about that was I sort of started in one area early in my career, figuring out where all the ads went. And then from there, I had a little bit of a serpentine journey through a variety of different roles, learning facets of the business along the way. So that culmination of experience led to the role of chief operating officer at Tierney. And so in that role, I had responsibility for the growth strategy of the business, the management and the cultivation of a team of 150 in 3 offices, development of new offers, and of course, ensuring that we met or preferably exceeded our financial goals for our parent company. So the sum of that career has given me an enterprise-wide perspective that's the core of what I do today with my clients. I find that business challenges are never just one thing. They never reside in one department. They involve multiple parts and pieces across an organization, and you have to understand how they come together or conflict to determine the path forward. I think the other really specific thing that working in advertising and communications taught me is understanding what consumers want and what exact problem we're trying to solve for them. So that intuitive curiosity to seek out what is it that my clients want and what do their customers want, and how do we bridge the gap to fill the need is really the fundamental work I do now.
Excellent.
And when you say what they want, okay, so I think one thing, it seems like it's common to most businesses, they want growth. They're not content with staying the same size. They want to grow. And I remember back in the 90s when we were growing Spree.com, it was crazy time. There was a lot of hiring, decisions, constantly pivoting from one idea to another. What are you finding to be the most common barriers to growth with your clients?
Mike, it often starts with making some assumptions or not making sure that they have really clarified a few things that are critical to driving the business. So yes, I hear, we need growth, but what does that mean for them? Do they want more revenue, a higher profit margin, more products, more people, more services, more locations? So we start to figure out, what that is and why they want it. And then we'll uncover the things that could impact that path to growth. The other thing that often happens is they're not always crystal clear on their metrics and regular tracking. So certainly huge data-driven organizations which many are today, have a lot of metrics and they are tracking it like crazy. And certainly the internet has helped us do that. But a lot of times I will find, especially clients in the small to mid-size sector, they'll focus on cash flow versus other important growth metrics like your profit margin or your cost per acquisition or the lifetime value of a customer or your customer churn. How often are they turning over? So I had a recent client, as an example, who had, very good top line revenue, but their overall margin looked curious to me. So I asked if they had taken a look at the revenue contribution from the other service areas. And once they did that, they found that one of their divisions was driving the margin growth and the revenue, while the other was actually draining it. So that began to help us focus strategically on, was that business unit really driving and an important offer for the clients? And they just hadn't really uncovered it at that place. The next thing that I ask always is at the beginning, what's your long-term goal for the business? Do you want to build a large team and scale and hang out there until, forever? Do you want to build a business to sell it? Are you building something to pass on to your family? And then you connect this to the long, you connect the long view to the short-term plan and priorities. So I'm sure you guys must know this in financial planning. If you want to sell your company, you need to set up these pristine financial measures early on. So there's a trend of growth and it's predictable, and you need to make sure that you are tracking EBITDA and all forms of margin, as well as the way that you're looking at a variety of other critical factors that are important to investors.
I'd like to build on that a little bit. In the current race to hire and retain great talent, that's on everybody's to-do list. What do you see as holding back clients when it comes to terms regarding their teams?
Most people understand and realize that their team and their talent is their most important asset. But what I discover is there is sometimes a lack of clear understanding of what roles you need and why at a given time in your business. And believe it or not, a job description for each of those roles specific that don't have a lot of bleed into the others. Some of the entrepreneurial firms that I work with in the startup, the founders will go from, chief cook and bottle washer and move in. And over time, I am coaching them to let go of things and hire talent so that they can, really focus on the growth of the business. Speaking of leadership, a lot of times clients will, if they've grown together with the company, have a tendency to micromanage, and they're reluctant to release the duties as they grow. Just talking to a prospect the other day, and he has a really healthy business 20 years in, and he's like, I don't know if I can let it go. And I said, well, if you don't, you're going to continue to sort of spin in this way. So how do we find you the right person to do that? The other thing is, if you are over involved, then people will begin to leave. Great talent will leave because they don't feel like they have a growth path with your firm. I think the other thing is making sure that you are looking at who your number two is. We always say, if I get hit by a bus tomorrow, who could take over? Actively cultivate that person. And I'll ask, are you threatened by them? And if the answer is a little bit, I say you should be. You want your number two that good. I think the last thing too about talent is you got to do annual performances reviews. The worst thing is when you have a really great, talented person who comes in and says they're leaving, and you say, I never knew. The flip side to that is sometimes your business outgrows the talent that you have. And that's a tough decision to make. So I think that it's really looking at your talent as objectively as possible and make sure that you're giving a lot of runway to those people that are killing it for you with a lot of promise, and that you're okay sometimes making the tough decisions to change out talent or evolve their role over time.
Yeah, the question about talent, obviously, that's what I kind of preach to everybody with businesses, that it's the people you hire that make the business. You can have the dream, you can have the plan, but those people are going to execute, and they're going to come up with new ideas that you didn't even think of when you set up your business, and they're going to help build it for you. But and you talk about the annual reviews, which I know a lot of people seem to avoid. They're afraid of them. I don't know, but the annual review isn't for you to criticize or critique the employee. It's probably more so for them to tell you what they're seeing, and to make sure they have an open, field for contributing.
So Molly, definitely we need to have you back again.
Thank you so much.
I would like to introduce our next guest, who will be Audrey Greenberg. And Audrey Greenberg is the co-founder of the Discovery Labs LLC. And I think she'll be a very interesting guest, because Discovery Labs is a global platform company that streams the path to commercialization for groundbreaking pharmaceutical discoveries. So be sure to tune in to see what Audrey Greenberg has to say. Thank you for watching today, and remember, your money matters.